It's been a boring week. The market has been climbing, and I think that up to that point you got totally bored. And we will talk about what we can expect the next week, when will be the time to go short. I need you to read that important disclaimer before we start. And this is the second page. So the main idea is that past results are not indicative of future profits. And this is the 5-wave up fractal. I think that the market has been following that macro 5-wave up fractal since the low of 2009. And we always review how it all started in 2009. We got the first ABC up, which topped in May 2011. Then we got ABC corrective pullback in corrective wave 2 down, which bottomed in October 2011. It retraced 38.2%. And then we got the first leg up, strong leg up, which topped in May 2015. It was subwave A of wave 3. Another ABC down in a corrective subwave B down. And this is what I keep telling my subscribers, that when we have a trending market, every single ABC down like that one, ABC is a buying opportunity until the structure is completed. So that was the final leg up, and in my opinion, the strongest part of the rally in wave 3, it's parenthesis 3, topped in February 2020. And if we come back for a second to the fractal, so I think February 2020 was here. So in my opinion, the whole rally that started off 2009 lows is not completed yet. And the main question for us here, the macro question, the first drop, the strong drop we got into mid-March 2020, was it subwave A of 4, only the first leg down, and now we are here, or it was very quick yet deep wave 4? And if mid-March was here, then the subsequent rally it was subwave A of 5, and most likely it has stopped already. And then we need to expect that ABC, the red zigzag down, that would be subwave B. But in many cases, you would have to face uncertainty in the market. You would not be able to identify only one most reliable setup. So you would have to accept uncertainty. But even if you have couple of alternative scenarios, you look for a point where two most probable scenarios would point one direction, and either we are here or either we are there. We still need to expect a move down, and this is what we will be discussing in this video. So that was a bearish count. You see, it looked like a subwave A, and then we got here and it's corrective subwave B, and we need to get another leg down subwave C, which has to stay over the critical support at 1788.50, because if that level gets violated, that would basically mean that in February 2020 we saw a major top in a rally that started in 2009. So we hope that even if we get that second leg down, it will be able to hold over that level. This is how those two scenarios look like. So we have a bullish count where we are topping in subwave A of wave 5, and then we need to get ABC down, or if it's a bearish count, if the first drop in into mid-March was not long enough, because the move down that started of February 2020 top is a reaction to the preceding rally, and the preceding rally in wave 3 lasted for 8.5 years. It's really difficult to believe that that first drop down that lasted only 1 month was long enough to be all of a corrective wave to that preceding impulsive wave. But looking at Nasdaq, we can see that Nasdaq actually managed to make a new higher high, and it's very unlikely that it was subwave B. So I would say that I would favor that scenario for Nasdaq and probably that scenario for S&P. And sometimes it's possible because you may remember that Russell failed to make a new higher high in 2019, while S&P and Nasdaq both made higher highs. So sometimes you see that only one index remains making higher highs, continues making higher highs, but other indices start to lag behind. This is a reminder that I've just announced a sale, happy 4th of July sale. You can find details in Castaway Trader /4th of July sale. You can find that banner on my homepage. So if you are subscribed to my website, you will go to updates, and here you have different sections: US stock indices, gold, silver, and GDX, crude oil, natural gas, value, and momentum stocks. So we will be talking now about ES, and let's click daily, and we will hopefully see the last weekend update. No, we don't see it. Let's say ES. So we are going to open first the last weekend update, and we will be talking about different alternative scenarios. This is the previous update I posted last Sunday, and I just want to show you different alternatives we have at the moment. So this is the very same 5-wave up fractal. You see the top made in February 2020, very sharp drop that could be A of 4, and the subsequent bounce still looks like a bounce because it has a clean ABC structure, and it retraced 85.4% of the preceding drop into mid-March. If you compare it with Nasdaq is much stronger. Nasdaq managed to make a new higher high, but ES and S&P 500 failed to make higher highs, so they could not even retest the top made in February 2020. And this is why it remains my primary bearish case. And with all that mess we see now in the US economy, it's not very difficult to imagine that the market can sink again under the weight of the fundamental bad news, which we get like every single day. So this is why it remains my primary bearish count, where over the top we may get an impulsive decline in subwave C over wave 4, and it can either retest the low made in mid-March or even make a lower low, slightly lower low or deeper lower low, but in any case I would like it to stop over 1788.50. This is our primary bearish case. And the primary bearish case, we got the first move down, that was A, it was into mid-June, and since then we've been bouncing like up and down in some corrective wave B up, and another push down in C could be only wave 1 of the impulsive decline in that subwave C. So it was A down, B up, and we need C down, which should be subdivided into 5 waves of a lower degree. And this is where we may be here now. So if it was February 2020 and the drop into mid-March was subwave A of wave 4, then most likely ES and S&P have topped already in corrective wave B up in early June 2020. We got the first drop. Let me show you this one. We got the first drop, subwave A. We got bounce in B, and we could get C. So as of last Sunday, we had setup for an immediate breakdown. But when we opened with a very small gap down, I noted for my subscribers that most likely bears are not ready to attack yet, and we can get another move up, and that was the count I offered. So I said, as that was posted on Sunday night, that we could get another rally. We could get another rally to around 3,170, 3,200, and that would be A up, B down, and C up, somewhere close to the tops but not making a new top, and that would be either the first ABC down of wave 1 down, or there could be a more bullish scenario where the rally of the mid-March was actually A of 5, subwave A of 5, and then we would only need to get one push down to get a corrective subwave B down before another rally starts. So let me show you this scenario. So this is an alternative bullish scenario. An alternative bullish scenario says that actually the drop into mid-March 2020 was all of wave 4. And if it was all of wave 4, let's come back to the fractal. If it was all of wave 4 into mid-March 2020, to make a lasting top, a major top in a rally that started in 2009, we need to get the final A up, B down, and C up. And in the very same way, I think that subwave A of 5, even under the bullish scenario, it has most likely has already topped. And if it topped early June 2020, we need to get ABC down. And this is exactly what that bullish scenario shows. So this is early June top, the first drop down A, then B up. Look, this is why wave B, I keep telling to my subscribers that wave B is very difficult to trade. And this is it is very difficult to trade for a reason. Normally, wave B is itself subdivided into A up, B down, and C up. But what makes it even more complicated is that micro B, in parentheses here, is itself subdivided into ABC. So basically, as a result, you get like mess. You get that consolidation, and it's very difficult to navigate through that consolidation. And the only easy part of that move is the very final push higher. And this is what expected to materialize as of Sunday evening. And this is how it played out. Let's try to open my trading platform. And this is 4-hour chart. Let's switch to 30 minutes. So basically we can see we got a really nice drive. So as of Sunday evening, we were here. I expected it to push down to tag that red target box, and once that red target box is hit, we may expect a move down, a strong drop which would have an impulsive structure, and under the bearish count that would be subwave C or wave 1 down, then ABC up that would be 2 up, making a lower high, and a stronger part of the decline in wave 3. It's under the primary bearish count. If we count it in a bullish way and we think that the top was subwave A of 5, then to complete a corrective move, we need to get A up, B down, and C down. This is how the harmonic Elliott wave theory works. It's pretty straightforward. It says that after every impulsive move, after every trending move, market needs to cool down in a simple ABC down structure. And you saw it many times. It moved up, then A, B, C down. This is what cools down the sentiment in the market and creates the stage, it opens the stage for another push higher. Because when market keeps pushing higher, bulls get euphoric, bears give up and cover shorts, and there's nobody left in the market who would be willing to buy the stock again. The very same happens with move down. The first push down happens, and when sentiment gets really bearish, we need to get some ABC bounce. And this is why we are looking for A up, B down, and C up, and we are almost there. Let's check 30-minute chart. So I use TradeStation for charting, and this is how the TradeStation works. I wouldn't say I love the platform, but it's a decent platform, and you can chart, you can get really good charts. So this is where we are on Sunday evening, and I was expecting to get 5 waves up, and we got ABC. Then we actually violate 3050. 3050 was a very important level which divided the bull market from the bear market. We violated that level, and then we made a tiny ABC down. That was wave 2, A up, ABC down. Last night I wrote to my subscribers that it's another great long setup because we are in a trending market, and that was only A of 3. We need to expect C of 3. So the rest is history. You know that by open we moved up strongly, and it's very possible that subwave C of 3 is completed here. So again, we are looking at the microstructure of the final subwave C. You see C of a corrective B up. Let me show you again 240-minute chart. The idea is we need to count 5 microwaves inside that rally to be able to call that subwave C completed. And once subwave C is completed, you get a full A, B, and C. Once you get full A, B, C, it becomes a full corrective B up. Once you get A down, B up, you expect C down. So as you can see on 30-minute chart and based on the red target box, ES still has some room to go higher. This is why I know that so many guys feel bearish now. I just checked from time to time my Twitter account, and I see like everyone is talking about disconnect between the real economy and the stock market, and everyone wants to short it, and I do want to short it, but I do believe that both NQ and ES still have some way to go higher. So look, if we topped in subwave C, micro subwave C of 3 this morning, we need to get A down, B up, and C down, probably to 3110, somewhere here. You see, it's 50 moving average with 50 period on 30-minute chart. It has been holding every single pullback so far, and most likely it will not be able to hold CO4 because wave 4 normally briefly violates support, only then just to resurrect and start pushing up again. So if we get that subwave C down into that zone on Sunday evening, don't get scared. It still can be a corrective ABC, and then we are left with another push higher. And that another push higher will most likely stretch to 3170, 3180, or 3200. And that would be a completion of a corrective subwave B up. NQ has a little bit different structure. Let's look at NQ. NQ has been much more bullish in a sense that it managed to make a new higher high. Okay, this is 60-minute chart. That's been hell of a rally of the low made in mid-March. That was ABC of 1, ABC of 2, then 5 microwaves up in A of 3, ABC of B of 3. We are looking at microstructure of NQ since the mid-March 2020, and the idea is that rally has been nicely following the 5-wave up fractal, and that rally is at the very final innings of that game because we can clearly identify the top of the strongest part of the rally in subwave C of 3. It topped at the beginning of June. Then we got a strong drop in wave 4, and you see it actually managed to hold the lower edge of the channel. And what you should know about wave 4, it normally likes to play the dirty trick. It briefly drops under any support you track, especially if you play with the channel. So it loves to drop under the channel, under the lower edge of the channel, only to bounce back into the channel and continue rallying again. So of that point of the low made in the mid June, they need to get the final A up, B down, and C up. But here market was tricky because normally subwave B down comes as a simple ABC. Here it came as an expanded flat where corrective subwave B managed to make a higher high but then drop down again. So when it goes over the top of subwave A, you think it's a breakout, and that drop down was all of parenthesis B down. But it moved up over the top, it fooled everybody, like it pretended like it was a breakout, and then dropped down again in some ugly structure. Though we can check, we can count it like 1, 2, A, B, C of 3, tiny 4, and the final tiny 5. So that could be counted as an impulsive drop in subwave C of wave B down. And of that low, which becomes our critical support at this point, we should expect the final push higher into the red target box. How we find that red target box? We actually measure the first leg up in subwave A, we project it from the bottom of corrective subwave B, and at the very minimum it should make a new higher high, and it has already been made. So technically speaking, Nasdaq has enough waves to call the top is in, but subwave C of 5 sometimes comes as a very strong rally, almost as strong as subwave C of 3. This is the strongest part of the rally. Of course, it could not be that big, but it could be, it could feel the same in terms of the way how it keeps pushing higher. Look, all pullbacks here are tiny. All bears who tried to fight it got defeated, and we are still leaking their wounds, and NQ still keeps pushing higher. So it looks like it starts to decline, and then we just buy it out and we push it higher again, and it can easily move up to 10,600 to 123.6% extension. Moreover, they could even play a throw out of the channel. It could it could go a little bit higher than that, just to scare bears and to make them cover. Now I want to show you VIX chart. VIX chart also is very important for us because normally VIX and S&P are inversely correlated. So we really want to see some bottoming structure in VIX, VXX, or other volatility products to kind of support our idea that the market actually is topping. And if you look at the structure that followed that huge spike in mid-March, we actually can count it in an impulsive fashion. So VIX topped around 85, which was an extremely high reading. It comes like once in a while, once 10 years when VIX gets that high. If it was 1 down, 2 up, we need to get 5 waves down to call that structure complete. We can identify wave 3 down as completed, and this is great because as long as wave, sorry, I just need to put it back, as long as wave 3 is not completed, it's very dangerous to attempt nailing that bottom. But if wave 3 down was completed in mid-May, we got a corrective A up, B down, and C up, another expanded flat. Look, a corrective subwave B down managed to make a new lower low under the low made by an impulsive wave 3 down. And then look at that very strong rally. So you think like another rally started, but no, it has not started. It was just the final push. So subwave C in any corrective ABC normally comes as a very strong move, which is a deceiving move because it makes you believe that another trending move starts, and it can make a new higher high in comparison to the previous high, but then it quickly collapses. And the problem here for bears in indices and bulls of volatility is that if it was wave 3 and if it was wave 4, we need to get the final wave 5 down, which would be structured as ABC. So we clearly can get some ugly A down. So A of 5 normally finds support at the point where wave 3 bottomed. Look at that. Wave 3 bottomed around the very same level, around 26.15. So at the moment we have 26.95. But that 26.15 has been tested twice this week. And this is a great sign. You see those long wicks. We have 3 wicks on 2-hour chart, meaning that finally VIX has found some support in that area. And look what we are going to get here. We are going to get here triple bottom, 1, 2, and 3. And this is what normally happens when subwave A of 5 finds its bottom. It's a deceiving pattern because many inexperienced traders really believe in triple bottoms and triple tops, and basically that pattern is only good for a temporary pullback. So in this case, what it means that if it was A of 5, and A of 5 in my opinion is bottoming here, we could get only a temporary pullback in volatility. It could be pretty strong. It could come back up to 36 retracing. So what you do, you just apply retracement. You add retracement, and this is exactly 50% retracement, 35.17. And look how many times wicks got rejected of that level. 1, 2, 3, 4, 5, 6 times. So basically we can understand that that level means something. In addition to that, what you can do, you can draw a trend line. You can draw a trend line and you can see where that pullback may find its top. Let me save the chart. Once we get that pullback, we should get the final push down. And that push down in subwave C of wave 5 needs to make a new lower low under the low seen in June. And when you have some expectation about another move lower, what you do, you come back to the left, to the past. You want to see, are there any parts of the chart, any behavior which would make possible to focus some support. And in this particular case, we have a huge unfilled gap up from 22 to 1821. When you have such an old unfilled gap up, look, it originated back to February 2020. So it's like 5 months old. It does not necessarily mean that that whole gap up would get filled. Many times we see that price would only be able to come back and test the upper edge of the gap. Maybe that gap could be filled partially. It could get a little bit into the gap and then just jump over that gap. So basically in the future, once we get that pullback and then push down again, you may start watching that gap down. And once we get into that gap and then go out of the gap, that could be considered a good long setup. Because if we get that 5-wave down completed, we would at least need to get a large ABC corrective move up. I'm running sale until the 5th of July. You can find details on my website. Just go to castawaytrader.com. You will see the banner. You click it. So the idea is you can get a membership of my premium trading chart. You pay for 4 months and you get 2 months for free. If you do not want to pay for the membership in the trading chart, you can subscribe to updates posted on the website, and then the deal would be even better. You pay for 4 months, you get 3 months for free. Again, you go to the page and you can read all details. If you have any questions, please send me email and I will be happy to provide you with details. Have a great weekend and enjoy your 4th of July long weekend. Thank you very much for your time. Subscribe to my YouTube channel, very important to me. It takes time, it takes a lot of energy. I would really appreciate if you could like this video. That would encourage me to record more videos. Thank you.